Hi, I'm Greg Newman, Group Chief Executive of Onyx Capital Group, and welcome to another episode of the World of Oil Derivatives channel. I wanted to start off this episode with an announcement of how we're going to do things going forward and a bit more of a wider announcement about what we're doing as a company and the role we think we have to play in the industry. So I've been leading various podcasts on this channel for 5 years now, and I've had a great time doing it. And it's a genuine thank you from me to those who have listened and those of you who have subscribed. It's fantastic to see over 1,500, I think 1,700 subscribers to our YouTube channel now. And we really appreciate the feedback that's helped us shape what listeners in the oil industry in particular, and I guess the wider financial community, and what they actually want to hear. The goal with our media is, and always has been, always will be, to support Onyx's mission to democratize oil markets and hopefully more markets in the future. This is about leveling the playing field for all in this most important of global markets. But what does that actually mean? You know, a lot of the time companies have wall art type things, right? This is a serious mission. And when we say democratize markets, the first thing we mean is leading with transparency. This is to make sure our information that we put out there is truthful and it's practical and it's useful. So we think there's a lot of information out there. There has been a lot of information out there for a long time about the oil markets. That's really circumnavigating what's really going on. It's kind of top level. And to be honest, I think now that information is so wider spread, it's not really useful anymore. So I'll give an example of this. Our new presenter, Jorge Montepeke, who runs our officials, he's been putting out more and more reports about the Dated Brent market. He's been putting more information about what's actually going on with his expertise as someone who actually created that benchmark in the first place. So you're not going to pull the wool over his eyes. Now, just by mentioning what's going on, some of the players involved, which is all public available information, that has got people very upset. We've had calls, we've had people very angry about it in the broker market, in the trader market, all gossip, hearsay, and it's just a bit of a joke. I mean, even this morning, we hear one particular counterparty is now refusing to trade with Onyx in the open market. You're not actually allowed to do that because this is what's called a block futures market. It means you're not actually meant to know who's on the other side of your deal. You're allowed to know the counterparty type, but not the counterparty themselves. So this is an example of what the oil market does and what it's about in its kind of nitty gritty. But we're opening that up. But the first thing is transparency. The next part in democratizing oil markets is access. So how can a market really be democratized if most people in the world can't even get access to it, even if they wanted to? Now, there has been a lot of change in this market. 12 years ago, the exchanges started listing oil swaps on the exchange. Now, what does that mean? Well, before it was all traded with banks, it was all bilaterally traded. So you just had to be a huge player, huge balance sheet to even trade one of these contracts. But now that the exchanges put these oil swaps on the exchange, they are technically futures. So technically anyone actually can now trade them like any other future, like Brent, like WTI. But you do need kind of a bridge to get there. It's still quite an opaque market. It's still quite an old school market. It's voice brokered. It's still 99% professionals. There's no real hedge funds. There's no retail. There's no real systematic algorithmic, but that's starting to change, and it's starting to change quite aggressively. So what we're here saying is, okay, how do we give people better access? Well, I'm really, really pumped to announce that we are providing a retail access offering ourselves. So coming soon this year, hopefully somewhere just before Q4, we are going to be launching oil swaps to the retail community. Now that means that literally anyone, obviously you can pass the background checks, can now trade with us and trade these oil swaps. It's going to take a bit of time to understand what's going on, how the contracts work, and how to trade them. But it's well worth the time to do it if you're interested in financial oil and financial markets in general. This is a hugely important market that just no one really has access beyond the professionals until now. So we're really excited about it. And that leads to the final part of democratizing oil markets the way we see it. So you have transparency, you have access, but then there's education. So it's our job to make sure this information, or the information we put out, is as digestible as it can be for as many different audiences as possible. It's horses for courses. Some professionals are going to want to know the nitty gritty, what's really going on. Some investors, some retail community are just going to want to know how it really works to start with. And whatever that is, we've got multitudes of channels of information that's going to be coming out more and more as we go forward. To that end, I will be handing over the day-to-day market updates and analysis to the research team, who will be beginning their own weekly podcast on this channel led by Harry Chinguerin. We have already launched the officials, which is led by Jorge Mentepeke, which will be more of a journalistic viewpoint of the oil market. And it's ran by, as I said before, the creator of the benchmark ecosystem that makes up the oil swap market today. You can also get your macroeconomic updates from James Brody's very popular Macro Mondays. And as always, there will be fun shorts from content like trade ideas, Woo Fridays, and more to come there also. We're also excited to further our reach even more with the launch of retail and investor friendly content, which will build into Q4 this year and beyond, in line with our offerings. So if you're wondering where I'm going to sit now, well, today is the first episode of a new format for my weekly show, which I'm now going to be calling the CEO Breakdown with Greg Newman. Now, this show will be discussing the industry itself, the infrastructure behind this market, from price formation to regulations to how information is being shared and distributed. I want to discuss the existing constraints on the industry, the financing landscape, the M&A dealings, and beyond. I'm still a trader by trait, and I also want to discuss the market conditions for traders and the prevailing sentiment among industry players from our viewpoint as the largest liquidity provider for oil swap contracts in the world. So as the first discussion point, I wanted to talk about the influx of hedge funds into the oil and commodity space in general, particularly in the last, I would say, 18 months. Hedge funds have come in droves, just essentially as soon as some of the big headline releases of big company profits, hedge funds profits, and trade house profits came out after the war in 2022, and of course filtering through into 2023. We had such huge volatility that pretty much every strategy that had been traditionally working in the oil market was now working 10x times. So we had very public announcements about, for example, Vital making record profit of $15 billion. Trafigura's the same thing. We had Citadel talking about how much money they made, huge, billions and millions and billions. So there was a bit of a sense that investors have been shunning the oil industry and commodities industry in particular outside of power and gas, so more the fossil fuel type specific industries. And as a consequence, they missed out essentially on these returns that were huge. Of course, a lot of the inflation that we had as a global economy and that filtered into people's day-to-day lives could have been hedged from an investor point of view from being in this market. So when it comes to hedge funds, remember the definition of a hedge fund is managing money, right? So they are managing investor money. So if investors want access to something, they're going to be talking to the hedge fund or talking to the fund who might allocate their resources somewhere else or to where they want it to be. And they're kind of looking pretty silly when they didn't have any returns to show for oil when you had all these companies who are making billions and billions and billions. Got to remember that the major companies, Shell, BP, Aramco, I don't think an investor is really going to be looking at saying, why haven't you gone and get the returns? These companies have got, at the end of the day, the investor exposure to these companies can be done with buying the stock price itself into these companies. This is more from a absolute financial kind of investment point of view. The trade houses are a bit closer to that, and certainly the hedge funds, that's exactly what they're meant to be doing. But the hedge funds that did do very well and came out and said it very publicly obviously made other hedge funds not look so great. So the combination of essentially a fear of missing out, probably looking quite silly, and probably investor pressure has basically brought all the hedge funds back. And this belief of, I guess, eco-investing or shunning oil as an investment from a price point of view backfired if the intention was to generate a return. So that's why I think why we've had them all rush in. And this is classic cycles. They've been out, they've been in again multiple times, even in my last 12 years of being in this industry. So the more well-known entrants in this space are the Bluecrest, the Balyasnys, Brevin Howard. We've still got reports coming in, the last couple of months. Isla Capital, Bobby Jane's new hedge fund, Jane Global, LMR Partners. There's a lot of hedge funds wanting to hire the best and go into this market. So it's still continuing. We've had a lot of churn. We've had a lot of people leave these hedge funds as portfolio managers, having joined only last year, but it looks like it's still going to be a theme in the markets. I think the first thing is that we already don't have the same market conditions by quite a long way in 2024 that we have had in the previous 2 years. Volatility has gone way down, and these hedge funds are quite actively searching for these opportunities when they aren't really there as they have been before. So people are already talking about this is not really the year to be in it. This is too late, and essentially kind of getting the impression that hedge funds are being effectively tourists in this space. So I wanted to go into more specifics of this in the actual oil market, the impact on the oil market every day. So just diving in to get a little bit niche, we've been doing podcasts all this year, of course, the analysis about markets, how people are positioned. And the beginning of the year, with the hedge fund presence, with a lot of people looking to obviously start the year with a bang, the idea was in 2023, towards the end, the return of the outright price and the predictability of the outright price wasn't particularly attractive. I think that was already being understood. So there was a rush into oil swap contracts, into differentials. And the thing with this is when you buy so ahead of the curve, so ahead of time, you've got so long until expiry. So from a classic trading point of view, that's time value, right? You've got a lot of time for that contract to move. That can sometimes be a good thing, but ultimately if everyone rushes into the exact same trade, there's going to be a trend. There's going to be a lot of buying. In this scenario, it was gasoline, it was diesel, it was fuel oil. Basically every contract was bought into for the Q3 months. Now, when pretty much the entire industry's discretionary capital was into these contracts, you can imagine the trend was pretty significant. And so, of course, this is what happened. It was actually quite a profitable trade for the first quarter for a lot of the industry. However, when you now have open interest so high, so much of the market so risk on into this area, you now have a lot of time to wait before it's actually going to roll off and expire, and everyone's kind of holding this baby. So essentially it put the market in a very vulnerable position. And the consensus views around this position were things like air conditioning, demand, refinery fires, the world global warming, making the refinery system potentially disrupted as it had been in previous years, and just general growing demand would put pressure on the whole kind of refinery complex. So in particular, it was the oil products that people were trading, as well as crude differentials. The thing is that when markets perform so quickly to price something in, that is the definition of pricing something in. Everyone believes something is going to happen in Q3, the growing demand, the refinery outages, that you set the price up there, and that's when effectively you can say it's priced in. Everyone's done their buying. But at that point, if these things don't happen, then almost by definition, like the market can't sustain itself. So just to sustain the price levels we got, we needed to start seeing these disruptions that were being talked about from a consensus point of view. Now, as the year progressed, there was all this talk about China demand being destroyed. There was the talk about basically refinery systems actually holding up very well. And essentially it looked quite quickly as we got into more Q2 that the market got way ahead of itself. So actually we had a very volatile Q2. But this is the thing about volatility. Talking about you wanting volatility to make a lot of money, but there can be bad volatility. And this is an example. Hedge funds come into the space and they're all chasing after the same trade. They're chasing after the same liquidity. And it's actually a big issue because they're leaving no room to basically allow for smooth markets. So when they want to sell back, there's no one to sell to because they've all done the buying, or the consensus has done the buying. So essentially people are chasing after the entry and chasing after the exit, and it makes it a very difficult trade. So I think the first clear impact has been this bad volatility. What does that lead to? How we're talking about it on the trading floor and the trading community is it's like people are grinding each other out their positions. So at the end of the day, they're all putting on similar positions, but slightly different entry levels. People have slightly different risk tolerances. And so that's definitely the first impact on oil markets, this sense of bad volatility that we know people haven't been doing very well as traders. I mean, for sure, the physical market's still doing very well, maybe not as well, but still very well. How some of the trade houses and physical players are positioned, they're not making as much, but it's still healthy, whereas the discretionary capital, the financial oil trading, the pure financial oil trading, commodity trading has been very, very, very difficult. And this is kind of what we would describe as grinding each other out of positions. Everyone's kind of had the same positions, but they have slightly different risk tolerances, or sometimes quite big differences in their risk tolerances, meaning some people have stopped out, but then it's rushed all the way back, and people are either still in the game and trying to rush back in, or they're ultimately blown up and they might have been fired or left or whatever. So it's been just a bit of a grind. So this leads to the next thing, which is the kind of trading styles. So there's been a big saturation of kind of CTA mentality, but that's kind of an old thing. CTA mentalities or CTA strategies of essentially momentum trading on the price has been around for a long time in the core futures. But more and more, that is the prevailing way to build a strategy within what we call systematic now. So systematic is rules-based trading, but the purest form of that, or at least the most well understood and applied version of that, is the CTA logic. So that is, say, the price moving beyond a certain technical level, crossing a 32-day average or something like that, and then people essentially come in and buy, and the reverse on the way down. But if so many people are trading that way, they might be labeling it systematic, but at the end of the day, they're all fighting over the same liquidity, like I said before, with the discretionary capital. And ultimately, you're at least eroding the edge that's there, so you're not generating money. But worse than that, you're creating market conditions that are a bit chaotic. And certainly, this leads back into that bad volatility narrative. We also can't forget that there's still a lot of geopolitical risk, or essentially concerns in the market. So, of course, we had a lot of conflicts this year, a lot of concerns. So on the back of 22 and 2023, where we had such huge moves in all markets, but in particular power and gas now, which I wanted to mention, because the power markets in particular are seen as the future. That's where a lot of the returns for the hedge funds and trade houses are going to be made. The problem is you're getting into a situation where there are markets in power, kind of Cal 25 right now, for example. Calendar 2025 contracts is what most people are going to be trading. If you want to trade the very prompt, you're getting into volatile movements in contracts, because it literally can move hour by hour. So there's essentially two markets. And if you're going to be trading into this prompt market, you actually almost certainly need the physical to back that up. So you need to actually own some of the transmission lines, the storage, you need to be part of that. Now, this dislocation between the prompt delivery market, what we call it in power, so this is actually literally consuming the electricity on the grids around Europe, if it's Europe you're trading, and that is where a lot of the money was made in the last few years. But you have a dislocation between what's going on fundamentally there, because by definition that is the fundamentals, that is the real physical market that is pricing in at the very spot, versus this Cal 25 contracts that's more used for power. And TTF is kind of similar, it's a few months out, but it's very different to the very prompt market. Now that dislocation between the two is huge. So you would say there's a lot going on. There's a lot of wind, there's a lot of renewables, there's very low demand from Germany, from Europe in general. And of course that means that generally speaking, electricity supply is very high and prices should go down. But yet the prices are rising in Cal 25. And that's because you're getting at, a difference in thinking, because it's a different in time value again. So the prompt is going to be very weak, but you can't trade those markets unless you're really active on the physical. It's very dangerous to do it without the physical. So you trade the deferred, but then the deferred is moving to things like geopolitical risk and just general financial market flows. And it's not really behaving at all like the basis has anything to do with it, like the underlying market has anything to do with it. So that's very obviously confusing for the traders who made a lot of money in 2022, 2023, or even 2021. And suddenly these strategies aren't working, because a lot of what they're doing is looking at the prompt and trading the Cal 2025 to reflect that. So hedge funds have a lot to do with this, because again, a lot of them rushing in and trading these views in the same way as everyone else, they are in some scenarios propping up the market, for example. So the geopolitical risk increases. We have talk about pipelines being disrupted, or drone attacks, or cutting off of whatever supply. So therefore, a lot of the financial market is going in and buying, and the hedge funds are saying, well, this is what we were paid to do. This is why we were brought back into this market, was to capture some outsized returns, which kind of has to be on the bullish side because of what happened in the last few years. So if they're always positioning to capture that, and there's enough people doing it at once, it can prop up a market for a long time. If you're going to say that price doesn't make any sense, the way to actually materialize that is to hold it all the way to the prompt. But as I just said, it's just far too dangerous as the way the power markets work right now. Oil used to have this problem, but oil got so financialized and market makers were able to enter that spot market. It became still volatile, but a lot more manageable from a risk management perspective. There was enough liquidity. And yes, it can still be very dangerous, but it allowed to actually at least have some connection with the forward curve. So I would say oil is quite progressive on that front. Electricity markets, absolutely not. So, and gas markets. So that is, that's very difficult for hedge funds. And essentially now, if the fundamentals aren't working as an indicator and everyone's got the same position, almost you can see how it's almost impossible to generate money in the same way, at least, as the 3 years previous to that. So now people are looking for different ways to trade. And that is the systematic argument I was saying before. A lot of people like mentioning systematic, like it's very complex. But again, the majority of those systematic strategies are just CTA style strategies, which have existed for 20, 30 years. In fact, they're called CTAs because it was a commodity trading association that started doing these things. And then the CTA logic's applied to all financial contracts now. So it's a very tried and tested method. But when there is no trend, the prompt is weak, the deferred is propped up because of geopolitical whatever, systematically, or from a CTA perspective, you're trying to buy into momentum and it doesn't work. You sell into the momentum on the way down, it doesn't work again. And that's been a huge theme this year. So if we look at the CFTC report for all markets, but particularly oil again, we have gone from maximum long to maximum short for their managed money about 3 or 4 times, which is in any other market or any other year would lead to quite significant moves. But we've actually been in a relatively small range despite huge flips in positioning. So this is discretionary hedge funds, discretionary capital coming in and saying, I'm bullish, let's say, and then CTAs are then acting systematically to then start buying into this trend. And yet we don't really reach a significant price level. No one really makes money. Something changes in the market, people start selling. And it's just junk, 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 junk. So it's been very difficult. And essentially the hedge funds just have had no edge. And it's kind of disrupted everyone's ability, I would say, to make money on a discretionary basis. So where do we move on from now? And this is the thing. I want to go back to the physical players. When we say volatility, I think it's really important to dissociate volatility in a different ways. Outright volatility, just the market's moving. Why is that so good for the trade houses? There is a distinction between trade houses and hedge fund volatility. Trade houses and majors, people who hold physical oil contracts, they absolutely love volatility because embedded in their contracts for the physical that's linked to the derivative market price, they have lots of clever optionality around that. For example, there's something called operational tolerance where you can maximize or minimize. You have the right to do that if you're a buyer or some cases the seller, depending on the contract. So you can actually ask for, say, a 600 kb cargo to be 606,000 barrels instead of 600,000 barrels or 594. So that difference is 6 kb either side, and that might not seem like a big deal, but you get to buy or sell that at previous level prices. So you say, right, I'm buying off you right now in May, and I've committed to buying it at that price for 600,000 barrels. It's now June. The price has gone up way more. You still have the option until that physical is delivered, and let's say it's delivered in July. You now can say, actually, do you know what? That level I bought it in May, now the price is a lot higher. I don't want 600,000 barrels. I want 606,000 barrels. And they have to give it to you, that extra 6 kb, at that lower price, that price it was before. So it's essentially free money. And it works the other way if the market moves down. They can actually buy less than they were intending to do by a slight amount. So operational tolerance is very, very common in pretty much every single contract. But there's way more of these things. And actually the very clever things that trade houses have done over the years is embed things in the contracts that actually the producer and consumer probably just doesn't care about. It doesn't actually affect their economics, but it provides a great trading landscape for the trader. They might be able to use it against stop losses, use it to kind of have options on their views. So it's a very clever way to enter and exit derivative positions that hedge funds don't have. Hedge funds have to go in and buy the offer when they want to buy, sell the bid when they want to sell. So you have to live and die by the financial oil market. Trade houses and majors have this inherent implicit edge that I just don't think enough people understand. So the more volatile a market is, the more they're getting these discrepancies between the prices and their contracts. Now, when it comes to hedge funds and you say the market's okay and the outright price hasn't been very volatile, but in some of these other contracts, the volatility is there, how can it be bad volatility? Well, they don't have this outright return on these contracts, as I said. So they need volatility that's quite predictable. So they could just trade options and buy and sell volatility, yes. And there has been trades to that extent. But actually, if you're just trying to capture long or capture short over a period of time, you want volatility in the sense of big price moves, but you don't want volatility in the sense of it's up and it's down, it's up and it's down. It doesn't really go anywhere in the end. That is a very difficult market to trade. And of course, you can always say, well, why don't you trade relative value then and all that? But market conditions and what's called regimes are changing all the time. And yes, the best traders adapt and they identify, we're in a range-bound condition, so I'm going to start deploying this strategy. Or we're in a trending market, so I'm going to start deploying this strategy. But that's very difficult to do because obviously we don't have the crystal ball, and just because the last few days have moved into a certain market condition doesn't mean that's going to continue. So it's predictability obviously is what we want. So a war is bullish and it's volatile. You buy, it moves up aggressively. That's the type of good volatility a hedge fund would want. But bad volatility where people are grinding each other out of positions and markets are moving here and there purely because of people wanting to capture returns and fight after liquidity, but actually nothing's really going on in the underlying market. That's not good. So where do we move from here? Well, the hedge funds are here to stay, right? They're not going to go this year, probably. It might take at least another 1 to 2 years. And if they start to do well again, ultimately, they're going to stay even longer. So I would say no one wants to miss out again. And I think there's an element of, actually, it makes sense. If you can stay in the game, you might not make huge returns. And if you're a fund of funds and you have a commodities area, it's worth having that area if they can make a small amount or even just lose a small amount over a few years. Because if you're there and positioned and ready, when the good market conditions come back, the good volatility comes back, you are there to capture it. And you can make 20, 30x returns, which more than justifies those few years of being on the sidelines, or at least just trying to stay in the game. So I think that's likely to happen. So that's one thing. But I think because of these hedge funds trading the same way, we are going to have to evolve. Everyone's going to have to evolve. So this is where data into artificial intelligence all comes in. So again, the weird thing about the market is there's not that many people who act independently. So if you're a new hedge fund who wants to go into the space and you've got a lot of investor capital who wants to see you deploy it, the first thing you're going to do is hire portfolio managers. So they're traders, but they're called portfolio managers. So where do you get these portfolio managers from? Well, you go into the experts of that field. So trade houses and majors who were trading derivatives at these houses. But remember, like I said before, they had a lot of implicit implied edge from contracts, from trading internally. So now they've got to go out into the open and trade just purely off their own back and no implied edge. It's a very, very difficult thing to do, and you live and die by your daily P&L. You've also got an investor to worry about. You've got managers to worry about who are just in it to see returns. They don't care about your market view. They don't care about anything other than, are you providing a return? So there's no explanation to be had as if the fundamentals are super important. It's just about returns. So when you come out of this implicit edge environment, go into the hedge fund space, put on a position. How did you put on that position, or why did you put on that position? What information were you using? Well, you're an expert. You trade, say, fundamentally most of the time in this market. And so you're saying, okay, I need these reports, say, from Energy Aspects, from Bloomberg, from I don't know, Kepler, whatever. I need to have all this data set, and I'm going to base a view on that information, about my understanding of that information, and I'm going to put a trade on. And the problem is everyone else is already doing that. You have just added new capital to go and chase after the same liquidity for the same trade. And actually, you don't have any of the implied edge. So if you're sitting at BP and you knew about all the tanks, you knew about shipping movement because you're literally doing the physical trading yourself, that information's firsthand. When you're sitting in a hedge fund, you may go and find that information from networking or whatever, but you're going to hear it second, third, fourth, fifth hand. So you're going to be relying on these modeling of supply and demand in the future, which is just essentially going to come from research houses and Bloombergs and all these companies. So where is your edge? Where is your time edge? You're getting this information pretty much last. So I think it's a very hard task to expect to pluck traders out of these companies who are just going to go and replace those traders with new traders, and you're not saying, right, that person made 100 million, take them out, we're going to make 100 million. You're taking that 100 million, they're going to make 100 million, and you're going to try and make 50. And is there 150 million available to be made in this way? Well, that's the eroding of the edge. Everyone can't fight after the same trade. That does not work over time. And actually 2022 proved that. The consensus position was long in oil. People were actually long at the end of 2021. Coming into the war, they were max long. And actually, shale oil companies and producers were even long because they were saying, why should I hedge? Which would be a sell. I don't want to sell because everyone's telling me it's going up. So why would I sell? And that makes perfect sense. So everyone either had an implied long position waiting to sell or was long. And when the war actually happened, it was mayhem. And actually, the exchanges had to put in constraints. They had to restrict, raise margin requirements. People had to put more cash down with interest rates, and it was just a shit show. And in the end, the market just collapsed on itself because everyone was long. Everyone had to sell at the same time to de-risk their positions, and the market actually went down. So the hedge fund community and the discretionary community, the financial volumes, the interest rate market, all that genuinely led to a market infrastructure move that moved a price that's meant to be fundamentally driven. So that's the kind of impact hedge funds can have by coming in all at once. So the good hedge funds, what are they going to do? Or the people that survive this and do very well, what are they going to do? Well, they're obviously going to be looking at things in a very different way. So it's this fight to find more data, to find more informational edge. So Citadel do very well in energy and commodities. The head of oil was in Lausanne talking not so long ago about the need for more data and how they apply it. So they go in and they find something that they believe is new. They have this data set A, data set B is now translating that data, and data set C would be, right, how do we actually trade off that? And at some point, people are going to catch up to that if it makes money, and it's going to be eroded, but he's fully aware of that. So then you keep going after the next thing. So this is this new search for data. But I want to just really make clear that on that journey, if you're coming out of a trade house and you're trying to trade as everyone else has traded, you're behind on that game. Citadel always, let's say, for example, 5 steps ahead. So you've got to find a way to get above that if you're going to long-term have an edge. So how can you have an edge if you're never going to have the physical? Well, you can either actually get into the physical, and there's a lot of talk about hedge funds actually getting into the physical themselves, and that's fair enough, and that might be a good strategy. But if you don't have that strategy, then you're going to have to look at markets differently. So when you say systematic, rules-based, artificial intelligence, it's going to have to be not the classic CTA style we've been seeing lately. That clearly is not working anymore. It might work again when markets really trend very nicely, but for the time being, there needs to be some diversification in thought and new data. So as a financial player, well, you're trading financial contracts. You can look more into the financial positioning, the financial flow, and start to get agnostic about what's actually happening in the underlying. Now that is a trader. They're just trading the market in front of them, however it presents itself. So there is now more of a push of information and data sources that target this area, so financial analysis. And that's where Onyx have been very vocal, because we're financial traders. We have all this positioning information and data, we're marketing it. And ultimately that information does allow you to be agnostic. And that's something I think obviously people should consider. We're pushing that, but us aside, it's not like we're the only ones. And G-Aspects, I mentioned them before, they're also bought a company that focuses on positioning flow analysis. I think it's becoming basically a staple for every research house. It's going to start needing to dig into this area. And it's the hedge funds and the trade houses and the discretionary traders' job to start using that information into strategies. And it is pretty weird. Someone's coming up and saying, I need to find a way to trade power markets or oil markets. That's nothing to do with the physical itself. That is an odd scenario, but this isn't new, and you just need to look at other markets to know that this is where markets go. The GameStop scenario was a perfect illustration of what can happen when everyone pulls together. And that was actually against the hedge funds. The hedge funds were way too short, and actually these very clever people, or maybe a couple clever people, realized and spread the word that they were so short that they were able to be squeezed if you buy enough, because ultimately that's financial positioning. And even hedge funds, even the biggest hedge funds, have a limit to their risk. So that rush, that huge move in GameStop, there may have been some fundamentals to it, but let's be honest, it was 100%, or at least close to 100%, a financial positioning move. So now the Citadels, the Jane Streets, whatever, they are more and more agnostic, I believe, about price movements fundamentally. They are literally just looking for financial flows like XTX in FX, and they're now looking at the retail community. I've heard a stat that 50% of equities that is traded in the US is from personal accounts. So it's just like the retail community, the everyday people are now a huge player. It's like having BP come in and that's, into the market, and that's actually now a retail community. That's the kind of impact retail can have. That's what I'm so excited for people to come in, because when you erode the professional edge, actually makes it easier for the retail community to come in, and it's leveling the playing field, which I was saying before, what it's all about. So meme stocks is a huge thing. This year, Nvidia was the huge stock, AI stocks, and it was just an absolute boom, and it dragged the entire US equity market higher, the indexes higher. We then had an unraveling of that risk from carry trades on the yen, and we had a micro crisis from this move. That again is 100% financial positioning, and everyone seems to know it. Everyone seems to be very confident talking about these things. So why aren't you putting it in your strategies? So I think there will be much more of this kind of movement as we go forward. An example of meme stocks as if it's just a flash in the pan. No, I think that's more likely to happen in more contracts. And I think oil, it might happen too. So as it stands, literally right now, there's been a recent report, I think Bloomberg reporting that the hedge funds are the most bearish on commodities since 2011. But actually, that's at least since 2011, because the data wasn't even there before that. So basically, the most bearish ever. What's going to happen when the hedge funds are so short? Maybe it's a GameStop scenario. I don't know, but this is the new reality. So I hope that was interesting. This is the type of thing I want to be doing. I would love to hear from you. We always say that, but no one actually does suggest anything. Please, if you want to hear something, even contact me directly, or the media team, or people at Onyx, because this now for me is going to be about communicating directly to the industry and trying to cover those things that I mentioned before. We're trying to provide as much access as we can, but it's the transparency, it's the education, it's the digestible information. What do you want to hear? I want to talk about it. And there will be more and more guests on, and I hope you tune in. I hope this is interesting. And again, thank you for liking, thank you for subscribing, and see you all again soon.